So how do you invest in real estate without the hassle? Well, that's exactly what we're going to be talking about today. We're going to be talking about some of the insider tips and tactics that you need to know to successfully invest in real estate. Look, I don't know if you've seen this, but the market's exploding right now. So how can you jump in and take advantage of that? Or how can you do a better job if you already have jumped in and take advantage of it? Well, with us today is Heather Dreves. Now, she's actually the director of funding at Secured Investment Corp and fund manager with one of the fastest growing companies in the private money marketplace in the U.S., focusing on residential real estate investments. Now, Heather is passionate about helping self-employed entrepreneurs and their families build wealth and succeed in their business ventures and helping investors deploy capital that is looking for a high-yielding passive investment backed by residential real estate. Now, she has seen real estate investors succeed and fail and is committed to tipping the scale to the side of success for everyone that she can. Heather, thanks for joining us today.
Absolutely. Thank you for having me. It's a real honor.
Yeah, you're in the right place at the right time. Like real estate's exploding right now, like especially in Florida where I am. Like it's ridiculous.
I think you and I are probably in some of the hottest markets. Honestly, I just was talking with a colleague out of Florida, and you guys are experiencing the same thing we are. We're Pacific Northwest, so specifically located in Coeur d'Alene, Idaho, but we're also right next to Spokane, Washington, which are some of the hottest markets. You know, a lot of people relocating out of bigger cities, California, Seattle, Portland, and we're getting an influx of people moving here, which is always great for the market, right?
It is. And it also brings up question of, is it too late? Is it a good time? You know, I hear that a lot is people say, look, have we reached a ceiling? Is it too high to invest now and then going to drop off? A lot of people have the concern. So what's your take? I mean, you're in the thick of it. What do you maybe predict or see regarding timing of investing right now in real estate?
Right. We still see this market as a great market to invest in. You know, we do a little bit of investing nationwide. We do a lot of investing specifically in our market. And, the hard assets that we're actually investing in, the real estate projects that we're purchasing and, doing rehabs on and selling is still a great market. I will tell you, Pacific Northwest, we get snow. So, naturally this time of year, home sales have slowed down a little bit, but the prices have not dropped. Like I said, this is a great area to move to. You have tons of people that can still work remotely. COVID, I think, changed a lot of companies' structures and opinions about letting people work remotely. So we see an influx of people moving here that are still employed, whether that's self-employed, corporate level jobs. And then also a lot of people that have retired, maybe even before retirement age, they were in markets where they were able to create a windfall and sell their primary residences. And now they've moved to areas like this for a better quality of life. And so we don't see it changing anytime soon. The other opportunity, isn't just the home sales, it's also the rental market. So because these locals have started selling off their properties because the values have increased so much, now they're in a position a lot of times where they're priced out of the market, which opens up opportunities for the rental market. So we don't see it changing. I think the markets are going to shift, but I think that's very geographically determined. And, because we are focusing specifically in the Pacific Northwest, we don't see that changing anytime soon. Probably more opportunity with some of these foreclosures too. Those moratoriums have been lifted in Washington and Idaho. And so I think in 6 months, there's also going to be opportunity to buy properties.
So, that's interesting. I wanted to talk about a couple different things like with that, but let's talk about the moratorium. What do you think is going to happen here? Because I've heard rumors that the amount of people in foreclosure now well surpass what we saw in 2008. And then there's a lot of other people that are in the industry that speculate that the government's going to do something to potentially even reset where people have another chance. So we don't have something like 2008 happen. Like, what's your take from being in the thick of it?
Yeah, I think that's also specific to the state, right? Washington state is a very conservative state, and they have been protecting foreclosure moratoriums. Idaho's a little bit different. We focus around non-owner occupied assets. And so that is a completely different situation than your owner occupied. I do think they're probably going to, try to preserve people's home ownership options. But it's hard to say. I personally don't think it's going to be as bad as 2008. I really don't. But I also think that there's a lot of initiatives out there to keep people in these properties. One of the strategies that we've been focusing on over probably the last, I'd say 8 to 10 months, is buying distressed landlord properties. So because, there was no rent control, there's rent control, you can't force people to pay rent. We were able to pick up a lot of properties at very deep discounts from landlords that, had tenants in them that weren't paying for 12 months or more. And we're starting to see that lift, but now there's also the caveat where you have to offer to get them rent assistance before you can actually evict them. And so I think all of that, whether it's evictions and foreclosures, that is all going to change. It's the way that was even 3 or 4 years ago is going to be a very different thing moving forward, for sure.
Now, when you say non-owner, are you buying non-owner properties, or are you buying properties for the purpose typically of renting them out or creating income producing properties versus primary homes?
No, that's a great question. So our funds focus around 2 different types of asset classes. They are always residential, so single family, 1 to 4 units. That's the lane that we stay in. I've been here 10 years and I'm part of a 3-man fund management team. And we decided a long time ago, you get these funds out there that want to be everything to everybody, right? They want to do self-storage and they want to do multifamily and they want to do residential. Our expertise is residential. So all of our assets focus around that. We do diversify our fund. And the way that we do that is we take 75% of our fund balance and we lend that money out to other real estate investors nationwide, right? And we will create a loan for them, provide them purchase money, rehab money, and then they make payments to us. So that's a big part of our portfolio. But that, again, is all non-owner occupied. These have to be for investment purposes only. Short-term loans, bridge loans, 12 months.
So are you
the other 25? Oh, go ahead.
No, I'm sorry. Go ahead.
The other 25% is held in hard assets in our local markets. So Coeur d'Alene, Idaho, Spokane, Washington. I would tell you that 2 years ago, we specifically only bought properties to fix and flip and get that quick turn on it. But because we are seeing the opportunity in the rental market, we have started to hold a few properties and cash flow those. What we really do is look at what's going to be most profitable for the fund. Is it more profitable to sell it off? Right now, turnkeys are really profitable. You can buy a property, stabilize it, get a tenant in it, and sell those as turnkeys. So that's another strategy that we'll start to utilize too.
Why do you think in general real estate is the place to put your money?
It's a hard asset. It's not like the stock market. You can have money invested in a stock market investment and the company goes out of business and you have nothing. At least with not necessarily just residential, but real estate in general, markets can shift, right? But it's a hard asset. You can do so many different things. Maybe your first strategy was to fix and flip it. Market shift, that's a great opportunity to cash flow it. You can sit on that hard asset. And I think that really just the fact that it is a tangible hard asset and you have so many other options in the event that markets shift and strategies change.
How are you seeing new people break into this space? Because obviously when, values explode like this, a lot of new people are getting in. So what's involved with getting started with real estate if you're not already in now?
Well, we actually educate people on how to find these deals. And we are not the type of real estate investment fund or company that encourages buying off the MLS market. So we encourage people, if you're going to get involved in real estate, first of all, educate yourself, right? Learn everything. And whether that's how to write a contract, how to, look at a contractor's bid to know whether they're giving you a legitimate bid to rehab a property, but also finding off-market deals. So we encourage people, buy out-of-town homeowner lists, make offers to people like that, look for distressed sellers, look for opportunities within your county and your local market with lien abatement houses. There's tons of opportunity for that. And I think really just finding the right deal is where a real estate investor starts off on the right foot, right? Not overpaying for it, not getting too emotionally attached to it and thinking it's worth more than it is. It's a numbers game, right? And if the numbers don't make sense and it's not going to be profitable, it's not a good deal. And that's where we see a lot of people fail too. They pay too much. They get emotionally attached to these properties. They think they've watched HGTV and have this idea that it's, all butterflies and rainbows, and that's not how rehabbing goes. It's a business, and I really think just probably the first step would be educating themselves first before jumping into it.
I'm interested with these kind of TV shows that you see. Do you think it's helped your industry or hurt?
Because the other part of our company is an education company, honestly, I think it's helped people, because people go out there and try to do it themselves and fail, and then realize it's a lot harder and takes a lot more work than they thought it did. And they actually end up coming to us to learn how to do it the right way. So I think it actually has helped. I think it kind of gives a bad name out there for private lenders. If you are not a private lender that manages rehab funds and you're advancing funds to borrowers and not controlling that through inspections and holding those funds back, you're going to get yourself in a lot of trouble. And that's what I tell people. Private lending is a buzzword out there, right? So you have people that have money that learn that they may be able to lend their own money to real estate investors. They don't do their due diligence. They don't put full title. They don't manage and control rehab funds, and they get themselves in trouble as a lender. That's not something that we help our investors do. You have, the other side of it is you have clients that want to get involved in real estate, but they have full-time jobs or they own their own companies, and they don't have time to be managing contractors and trying to rehab them themselves. We actually offer opportunities for that through our funds. So they can invest money in our funds and we manage it. They reap the benefits of it. They're yielding double-digit returns. And now they're invested in real estate, residential real estate specifically, but they don't have to do all the heavy lifting.
So the way that your model works is that you do all the work and then somebody else could just front the cash and get a return on their investment.
Absolutely.
So what kind of returns do you typically see your investors receive?
Well, our funds have been historically yielding double-digit returns, 10 to 11%. And that's a very passive way to invest. We have a fund that has a minimum of $1,000, so they can get started with as little as $1,000. We work with a lot of our clients that use self-directed IRAs, so tax-deferred strategies. And then if it's someone that's a little more active and a little more risk adverse as far as an investor goes, they can also buy first lien position notes from us. So these are notes that we've created where we already lent somebody money. And now when this investor buys that note, they're now the lien holder against the property. Returns on that can be anywhere from 8 to 11%. But now they're secured by a first lien against a property with at least 30% equity in it. So pretty low risk, right? Borrowers make interest-only payments every month. And then when they pay the loan off, they pay the principal balance off.
That's really interesting. And you have another level, I think it's 50,000 that's minimum to get in. And then somebody there needs to be an accredited investor, right? And they get a higher rate of return with that.
A little bit higher. Yep. They're putting in a little bit more initially to get started. So naturally, the pricing on that as far as what the yield is a little higher to them.
Now, do you see people that take money from self-directed IRAs, 401k, stocks, bonds, things like that to invest with you guys?
Absolutely. I would tell you, I bet you 80% of our database of investors that we work with use some kind of self-directed IRA of some kind or a self-directed 401k. It's a great tax-deferred strategy. I don't know, excuse me. Most self-directed IRA custodians now are also set up to use health savings accounts, college savings accounts, IRAs, Roth and traditional, and then there's opportunity to roll 401ks over. I talk with people all the time. Hey, I have a 401k from 5 employers ago. I don't think I ever did anything with it. And they're just sitting there. So our fund that has the minimum of $1,000 and doesn't require them to be accredited is an awesome opportunity to roll those kind of accounts over and get them working for them. We're here to encourage people to create wealth for themselves. Our goal for everybody is to become an accredited investor. And we do strongly believe that investing in residential real estate specifically is a great opportunity to create wealth for themselves and their families.
Yeah. It's interesting because one of the products we deal with is securities financing, stocks and bonds. And so when I think about that, somebody could borrow against stocks and bonds, still earn interest. They still keep staying invested. They still there. They get, 5% interest credit line. and then you're getting them 10% per plus sometimes returns. So it's like they've got money that's already invested, that's earning a return. Then they leverage that again, can get a credit line and then invest with you guys. I mean, it's just smart all the way around when you're using these stocks, bonds, 401ks, IRAs to do what you're describing.
Even life insurance policies, it's infinite baking, right?
Right.
And that's what we're here to help people do. It's low risk. Again, these are all secured by residential real estate assets. And depending upon whether they are more inclined to invest in the fund, which is just very passive, pays out monthly and quarterly returns, or if there's someone that wants to look at buying a trust deed, those also pay out monthly cash flow options. So great opportunity for those types of accounts.
So what are the most important factors? Like if I'm investing into a real estate property, what are the factors that you look at that really make it a phenomenal property to invest in?
Well, first is value, really understanding what the true value is. And I look at two things, right? I look at as is value. So what's that property worth as it sits, right? Because what that property is worth as it sits is what you should be paying. You shouldn't be paying more for that. And we get people coming to us wanting to borrow money and they're paying, 30% over what that property is worth. And it's like, this deal doesn't make sense. You qualify as a borrower, but this is a terrible deal. We would be doing you a disservice, loaning you money, putting you in that deal because that property is not worth what you're paying. So one, understanding as is. And then if there's rehab and you're going to improve the value, understanding what that after repair value is and your market, right? I get tons of people, well, I looked on Zillow, it's worth X amount of dollars. It's like, you can't just base your opinion off of Zillow. You need to do more research than that. So really understanding what the value is, both as is and after repair, understanding if there is rehab, what exactly needs to be done to make that property either sellable or rentable. So there's different strategies, right? You're not going to go improve a property with granite if you're renting it out in, low income housing. So really understanding what your exit strategy is. Are you trying to cash flow it and rent it? Or are you trying to flip it and sell it? It's completely two different projects. And I think really that's it. People come to me and they're like, I don't have the money. That's not the problem. The money's you can get money if it's a good deal. You need to determine if it's a good deal. And I think that's where a lot of people, and I mentioned this earlier, they get so emotionally attached to these properties and, well, I think it's worth that amount of dollars. It's like, there's no way it's worth that. So really understanding the deal is probably the most important thing.
You talk about Zillow, and I'm interested because a handful of people in my circle are just believe without a doubt that Zillow is buying properties, they're reselling them at a higher amount of money, inflating the market, and then they continue this process. Is there any reality to this? Is this
well?
Really
they actually, I don't know if you saw the news a couple of weeks ago. They have halted buying properties. Apparently, Zillow's not very good at that. It was all over the news. They actually were doing that, and I think it was about 2 or 3 weeks ago. A big news posting came out that they have stopped buying properties because they couldn't sell them. And that's exactly what they were trying to do, was inflate them. When we look, I use Zillow as a tool, but I also look at, okay, I don't know if you've looked at Zillow real closely, but you can pull up lot lines and it'll tell you what properties is sold for directly next to it all over. And that's what I use as a basis with Zillow. We have other tools we use. We use appraisals. We use some hybrid products out there that are not exactly an appraisal, but someone's going. And the other thing is I believe strongly in is getting in and looking in that property. I have people call all the time. I'm in California and this real estate agent in Ohio is trying to sell me a property. He says it's a really good deal. And it's like, have you even looked inside that house? No, but the agent said it's great. Well, he's the selling agent. I'm sure he does say it's, they're just too trusting. And so, I like Zillow. I don't hang my hat on it. And I have read things that said that they were doing that, but apparently they weren't very good at it. So that's not happening right.
What are some of the things you've seen in properties where that could be a problem? Like, where are the properties that you guys have looked at, been told it was a good deal, whatever, then you physically go put eyes on it and you're like, oh, heck no.
Chicago, Cook County is one of them. Cook County is a very distressed area. However, we lend there and we invest there because nobody else wants to be there, right? So there still is opportunity, but we've gotten in properties that from the outside, from the street, look like a brownstone brick, and you get inside and the whole thing's gutted to the walls.
Wow.
Yeah, I mean, a lot can happen, and people can be very creative with pictures and listings. And so we always want a third party going in. We want a third party, whether it's an inspector, another third party agent, an appraiser going in, giving us an opinion of value, giving us an opinion also of what it would cost to rehab it. We sometimes get borrowers that come to us and say, my rehab bid's $30,000, and then we send a third party out there and they're like, there's no way they're rehabbing this for 30. It's not even habitable. It's going to cost at least 100. So also understanding from a lender's perspective what a rehab actually costs to do. And because we do that ourselves, we have a very good pulse on these loans that come to us. Like, hey, that is not a accurate or a realistic bid. We think it's going to need at least X amount of dollars. Because the reality is that borrower might not rehab that property, but as a lender, we want to be well positioned that we have enough money held back that we could take that property back and we can get in and rehab it. I have 100% confidence in my team, but we got to make sure that the dollars are there and the numbers are right.
So what do you do in those situations? I mean, you have to have a lot of, maybe you don't. Do you have a lot of newer investors that are coming in trying to do fix and flips where they're just radically underestimating the cost that it's going to take to rehab the property? And if you do, like, how do you navigate those situations?
If we suspect through underwriting that the rehab bid is too light and does not address everything, we will actually send out a third-party inspection company that will do a cost analysis on the rehab. They'll come back and say, and we'll give them the original bid. Hey, here's what they told us it was going to cost, and then we'll adjust it. And, sometimes the deals die, and sometimes there's enough equity that we can adjust the loan amount. And even if they get it done for cheaper, right? Like, let's say, they believe it's only going to cost 50, but we believe it's going to cost 70,000, and they get in and they get it all done, and it only costs them 50. Well, then great. There's an overage of 20. But in the event that there's unforeseen things that come up, at least they have those additional funds that we can get. The goal is for them to get the project done. We want them to make their payments, get the project done, and exit our loans. That's our goal, and we want them to make money. So we will go, to answer your question, I kind of went down a rabbit hole. We will go right back to them and say, we don't believe this bid is accurate, and we believe it's probably going to cost more, and we'll send a third party out there. And if they let us do that, great. Sometimes they go and they find money other places, but we have a fiduciary duty to protect our funds and our investors, and that's our first goal.
What about choosing the best real estate strategy? Like, how can somebody determine if they should buy and hold and rent, or buy to fix and flip? Like, what's the determining factors there?
So we tell our students that unless they have $250,000 in liquid cash funds, they should not be buying rentals. So fix and flip first, build up your cash reserves. When you own rentals, and I own some myself, there's always going wrong. Tenants and toilets, right? Either you got tenants moving out or toilets are plugged up. So you have to have some cash reserves. So we do not encourage any of our clients to buy and hold rentals unless they have at least $250,000 in cash. Now, one of the things for somebody that's higher net worth, that maybe doesn't need an investment that cash flows, but is looking for tax deferred strategies, a rental is a good option, a turnkey, right? Because they have depreciation and things of that nature. Or maybe they owned an investment property, or I work with a lot of dentists that own the buildings their practices are in, and then they sell them. Buying a turnkey is a nice opportunity for a 1031 exchange where they can move those profits into another investment property. So I think as far as what's the best strategy, it depends on the person. Where are they financially? What is their actual goal? Are they trying to create cash flow? Are they trying to create growth and just, are they younger and just wanting to grow those accounts? Then probably investing in our funds is a better option because they can reinvest their earnings and just compound it. So really, there's probably not one answer to that question. It's really specific to the client.
If I get involved and invest, like, what does it look like return? How long before I could get my money out? How many of your people roll the money that they're making over to their next deal?
Okay. So the funds have a 12-month tie-up period. So you do have to commit to staying in for at least a year. And with those funds, you can reinvest all of your earnings, or you can have your earnings paid out. So it's really up to the client. And again, really what their strategy is. If they're buying trust deeds, and so first to back it up, if they invest in the fund, their money is immediately deployed. The minute their funds hit, they are earning the yields of the fund. So there is no hold period. With the trust deeds, when those loans pay off, we will call them and let them know, hey, Ty, your loan's paying off, probably going to be a couple of weeks. Do you want to start looking for another note? Because private lenders joke that the worst time is when they get paid off, because they want their money out there deployed all the time.
Sure.
So a lot of times we can find them another option before their loan even pays off, and then we can just roll their money into the new loan once they decide if they want to move forward. So it's very
the math of this, just theoretically, let's say high number, let's say put in $500,000, right? $500,000.
Mm-hmm.
So then in a year, I could potentially make 10% on that.
Yep.
Right. So make 50 grand to come out. You come out, hey, you made 50 grand. You could take it now or reinvest. I'm like, oh, I'll reinvest it. If I reinvest it, I can make another, whatever, 60 grand. So, I mean, is that real numbers? Like if I put in $500,000, then I could be looking at, 110,000 in return on that within like a 2-year time period.
Absolutely. And it could be a little higher because our funds pay out quarterly. So those earnings are rolled in quarterly. It's not at the end of the 12 months. So we pay all profits out every quarter. So I'd say, more realistically, it's probably closer to 10.5%, 11% yield. And I have real life examples of people that do this. And a lot of them reinvest because they're not looking for the cash flow, right? They're looking to just build these, and especially like IRA accounts, like what an awesome option to be able to reinvest and grow those accounts because you're limited to your contributions yearly, right? And so this is a way to just keep reinvesting and grow those accounts at just a high pace.
So what risks do I really face with this? Do I have a real risk of losing all my money?
Well, I mean, there's risk in any investment. I like to be open and transparent. Our funds are set up as LLCs, so our fund members are equity owners in the fund LLC. They do get K-1s at the end of the year. And, all of the assets, again, that are in there are residential real estate assets that the fund owns, in the event that there's a market, the risk I see is the market shifting, right? Maybe values decrease. Maybe, foreclosure laws become harder. You can't evict. There's still options to still cash flow those properties. I don't see well, first of all, we've had funds for 10 years. Our funds have never earned less than the preferred rate of return, and they've never lost any money. These funds are fully audited. They're audited by an outside auditing firm. They're also monitored by the SEC. We would not still be in the fund management business if our funds were losing money. So in my opinion, I don't see it any riskier than any other kind of investment. I actually feel like it's less risky because there are hard assets that are backing these funds.
What if so if I come in and I invest, am I investing into one property, or is it kind of my money diversified over multiple properties?
In the funds, you're diversified over multiple properties and multiple loans. And that's another thing that a lot of people really prefer the fund over the trustee. It's easier. You're diversified. Your money's always deployed. You don't have the situation where I'm calling you saying, hey, Ty, your guy paid off. Let's find you another deal. There's no guarantee that there will be, but we have good deal flow. I don't see that as an issue. But some people prefer the fund, because they're out traveling and they're working and they don't want to deal with trying to find somewhere else to put their money. So in my opinion, the fund is a lot more passive and much more diversified because it's, instead of taking your 100 grand and buying one trust deed, your 100 grand is deployed over 400 trust deeds.
Makes sense. So many questions I have, but we're out of time. So where can everybody go, Heather, to be able to learn more?
Yeah, absolutely. So they can always visit our website at securedinvestmentcorp.com. So that's securedinvestmentcorp.com. We actually have all of our trust deeds on there that we sell. We also have information about both of our funds, and you can actually schedule an appointment with me if you want to talk further about it. We'd love to, give you more information. I always feel like these podcasts, 30 minutes just doesn't seem like enough time because there's just so much information. But I'd love to talk with you more about, what your strategy is. And then based upon that, could probably get you a lot more information.
Awesome. Heather, thanks for coming on today.
Yeah, thanks for having me.
All right. So if you're watching this, you're already investing in real estate, you're thinking about investing in real estate. When you get started in real estate, you're going to mess it up. It's just the way it is. I mean, I don't know anybody that hasn't got into real estate investing where they've made a ton of mistakes and left a ton of money on the table or even lost money because the numerous amount of mistakes that there are to be made. So many: buying the property at the wrong price, looking and finding the wrong contractors, paying way more to have the work done than you think it is, underestimating how much work and money has to go into the project. I can go on and on and on. I mean, I have people that come on the show all the time and talk about their failures with real estate investing. But here's a path forward where you could just get a significant rate of return without doing any of the work, without falling in the pitfalls, without making mistakes, where you're able to work with people that have already made those mistakes, that have learned those lessons. And now you're benefiting from all of that knowledge that they have. So if you want to learn more about this, make sure you go to securedinvestmentcorp.com. That's securedinvestmentcorp.com. A lot of great information here. And what I like is that you can see the options that Heather talked about right easily on the website. I mean, you can see the return, you can see the minimum contribution, you can see all of the details right here. And as she said, they're really big in the education space, which I love. So you can kind of go either way. You can get a lot of education, work with them on the training side and do it on your own, or go in, not have to do the work and just get a rate of return. The option is yours. And for as little as $1,000 to get started, why not? I mean, it makes a lot of sense. So make sure you go to securedinvestmentcorp.com to learn more and make some money with real estate here. Be able to invest in real estate and get a high rate of return without the hassle. So to get started, go to securedinvestmentcorp.com. Thanks for tuning in. Have a great day.